Ajay Rajadhyaksha joins us. Ajay is a managing director at Barclays Capital. He's garnered top rankings from the Institutional Investors Survey in its derivatives category. Ajay, welcome back to Bloomberg News. Always good to have you on.
Good to be back.
Ajay, we were just talking about the possibility for default for some sovereign nations. I was wondering if we might get your thoughts on that.
I think there is some possibility of default for some of the weaker nations in Europe, but we don't think default is imminent. What we think is far more likely is that over the next 18 to 24 months, as a lot of these austerity measures are introduced, some of the nations, it becomes politically difficult to implement a lot of these austerity measures, and that is the point at which that restructuring starts to become likely. The one thing I do want to point out, though, is that there is a difference in the fiscal situation of, say, Greece versus that of Spain. In Spain, for example, the market is not so much worried about the deficits that they have or the debt that they have as their ability or inability to grow going forward. So each story is somewhat different, and it's difficult to club all of them together.
Well, Ajay, as Bill Gross told me earlier today, when you have these countries that are implementing austerity measures, whether it be Greece or Spain or some of the other countries in Europe, how much of a constraint does that put on growth? It makes it tougher, doesn't it?
Very much so. It is a very difficult, very delicate balancing act. The fear is that you end up doing too much of a fiscal austerity measure, even if you can politically, and you slam growth so hard that you go into a cycle out of which it is very difficult to come out. Having said that, I think most countries in Europe which are in trouble right now have no choice but to walk this fiscal tightrope, and it is possible that some of them will fall off.
Ajay, might I ask, we see that spot Libor RIS has doubled, more than doubled since late April, but it's still below crisis levels, correct?
Yes, that is correct.
Talk to me about the significance of that.
The significance is that there's one very, very big difference between now and, say, the second half of 2008, which is that over the last 2 years, banks have been told by regulators to consciously reduce their dependence on the commercial paper market, on the wholesale funding markets. Number two, banks have an enormous amount of cash on hand. So yes, they might face funding pressures. We think some European banks are facing funding pressures right now, but the big difference is they actually have large amounts of cash on hand to offset those funding pressures, and that is why even as Libor OIS has risen, you have not seen it go to crisis levels.
Ajay Rajadhyaksha, Barclays Capital, joining us. Ajay, always good to hear from you. Thanks.